Breaking news out of Ottawa. And what is unfolding right now represents something far more consequential than a routine trade dispute. This is a structural shift in how North America's economic relationship functions, and the implications reach well beyond tariffs or short-term negotiations. For months, Washington operated under a familiar assumption that tariffs are leverage, that pressure creates compliance, that Canada, as America's largest trading partner and most integrated ally, would eventually return to the table seeking exemptions, carve-outs, and restored access. That assumption proved catastrophically wrong. On February 1, 2025, President Trump signed executive orders imposing sweeping tariffs on nearly all Canadian goods, 25% across steel, aluminum, autos, lumber, and manufactured products. Energy exports received a lower rate, but the signal was unmistakable. This was the most aggressive trade action ever taken against America's closest economic partner. The justification followed a familiar script: trade imbalances, border security, defense spending commitments. The political logic was simple: apply pressure, extract concessions, declare victory. Early economic forecasts painted a grim picture for Canada. Analysts warned of $50 billion in lost exports annually, GDP contraction exceeding 2%, manufacturing job losses. The expectation across Washington was that Canada would respond defensively, seeking exemptions under USMCA just as it had in past disputes. But that is not what happened. Instead of escalating rhetoric or scrambling for relief, Canada made a strategic calculation that fundamentally altered the game. In April 2025, Mark Carney, former governor of the Bank of England and the Bank of Canada, won a decisive election campaigning on economic sovereignty and long-term resilience. What followed was not crisis management, it was redesign. By November, Carney unveiled Budget 2025. Not a temporary stimulus, not a tariff response package, but a long-horizon transformation plan centered on mobilizing $500 billion in private investment over 5 years, backed by more than $78 billion in direct federal strategic spending. This was not reactive spending. It was a deliberate pivot away from structural dependence. Here is the detail Washington underestimated. By March, the Trump administration had already granted USMCA exemptions covering roughly 85% of Canada-US trade after Ottawa increased border security cooperation. On paper, the tariff crisis was largely defused. But Carney did not reverse course. He accelerated it. Why? Because the Canadian government reached a conclusion that went beyond tariffs. If trade access can be weaponized regardless of treaty protections, then dependence itself becomes the vulnerability. This was not about Trump. It was about future administrations, future elections, future shocks. The objective was clear: reduce Canada's reliance on the American market from roughly 75% of exports to below 60% within a decade. Not through disengagement, but through diversification. This is where the strategy becomes sophisticated. The $500 billion figure is not government spending. It is private capital, domestic and foreign, unlocked through policy design. The federal government committed roughly $150 billion in tax credits, loan guarantees, regulatory streamlining, and targeted subsidies. Economic modeling suggests that for every dollar Ottawa commits, $3 of private investment follow. The priority sectors are not symbolic. Infrastructure, clean energy, advanced manufacturing, technology, critical minerals, the inputs that define industrial competitiveness for the next generation. Canada introduced accelerated capital cost allowances, allowing firms to write off 100% of eligible investments in the first year. It created a $25 billion growth fund focused on clean technology and critical minerals. And most importantly, it centralized regulatory approvals through a new Major Projects Office, compressing approval timelines from years to months. But the most consequential element sits beneath the surface. Access to these incentives is conditional. Companies receiving support must source a minimum of 60% of inputs from Canadian suppliers or allied partners. Not isolation, not autarky, strategic alignment designed to reduce exposure to any single foreign market. This is economic nationalism implemented through multilateral diversification. And defense spending, long a point of American criticism, was folded directly into this framework. Canada committed more than $80 billion over 5 years to military modernization, reaching the NATO 2% target by 2028. But instead of importing capacity, the plan focuses on building domestic defense manufacturing. Aerospace, naval systems, cyber capabilities, tens of thousands of skilled jobs. The message was unmistakable. Canada was not asking for permission. Canada was building alternatives. What Washington framed as leverage became justification. What was meant to enforce compliance became political capital. The tariff strategy did not weaken Canada's bargaining position. It gave its leadership the mandate to restructure the economy. And that is the first fault line. Because once a country invests in permanent alternatives, leverage does not return, even if tariffs disappear. To understand the real impact of Carney's strategy, you have to move past announcements and look at flows. Capital flows, trade flows, employment signals. This is where the consequences stop being theoretical and start appearing in quarterly data. The first sector to feel the shift was steel. When U.S. tariffs on Canadian steel reached 50% in early 2025 before settling at 25% under partial USMCA exemptions, Canadian producers lost billions in access to their primary export market. In the old playbook, that loss would have translated into layoffs, lobbying, and pressure to restore access. This time, Ottawa intervened differently. Rather than subsidizing losses, the government offered loan guarantees and retooling incentives tied to market diversification. Steel producers were encouraged to adapt production standards to European and Asian specifications. The result was immediate. By the fourth quarter of 2025, Canadian steel exports to the European Union rose more than 30% year over year. Shipments to Japan climbed nearly 30%. The volume was not identical to what was lost in the United States, but the dependency profile changed. Canadian producers were no longer exposed to a single political decision in Washington. The same pattern emerged in manufacturing. Take a mid-sized automotive parts supplier in Ontario. Before 2025, over 80% of output flowed to assembly plants in Michigan and Ohio. That concentration had always been efficient. It had never felt dangerous. The tariff shock forced a reassessment. Under the new investment framework, companies received tax credits for building capacity aimed at Asian electric vehicle markets. Procurement preferences rewarded firms supplying Canadian EV and battery projects. Export insurance reduced financial risk when entering unfamiliar markets. Executives who had resisted diversification for years suddenly had political cover to act. One manufacturer told Reuters that the tariffs forced them to confront a vulnerability they had ignored because USMCA created a false sense of permanence. That sentence matters. Because permanence is the illusion tariffs shattered. Now look at the American side of the ledger. The United States exports roughly $350 billion in goods to Canada annually. That makes Canada the second largest export market for American producers. When Canada imposed retaliatory tariffs in March 2025 on steel, aluminum, and agricultural products, the impact was immediate. Farmers in Montana, North Dakota, and Minnesota saw wheat and soybean exports to Canada drop more than 40% year over year. Even after retaliatory tariffs were lifted later in the year, market share did not rebound. Canadian buyers had already secured alternative suppliers in Australia, Brazil, and Argentina. Trade economists will tell you this is the most dangerous kind of loss. Not price-driven, relationship-driven. Once buyers adjust procurement chains, they rarely revert unless there is a compelling reason to do so. Stability beats nostalgia. Energy provides another example. Canada supplies more crude oil to the United States than any other foreign country. The 10% tariff on Canadian energy added meaningful costs for Midwest refineries that lack direct access to domestic shale production. In competitive states like Michigan, Wisconsin, and Ohio, Consumers saw fuel prices rise throughout the spring and summer. Political pressure forced exemptions, but confidence damage remained. Refiners began reassessing long-term supply strategies, not to abandon Canadian oil, but to reduce exposure to policy risk. This is how integration unwinds, not through divorce, through redundancy. Automotive manufacturing reveals the deepest vulnerability. A single vehicle assembled in Michigan contains thousands of dollars in Canadian-sourced components. Tariffs applied even briefly forced automakers to absorb costs to remain competitive against European and Asian imports. Ford cited tariff-related supply chain disruptions as a contributor to more than $1 billion in lost revenue in mid-2025. Those costs do not vanish. They accumulate. They shape future investment decisions. Now consider the scale of what Canada is building. The $500 billion Carney is mobilizing is not transient stimulus. It is ports, rail corridors, clean energy grids, telecommunications infrastructure, facilities designed to support long-term trade with Asia and Europe. Once those assets exist, trade geography changes permanently. You cannot unbuild a port. You do not abandon a rail network optimized for trans-Pacific trade. You do not dissolve supply agreements signed with Asian manufacturers simply because relations with Washington improve. This is the part Washington underestimated. Tariffs are reversible. Infrastructure is not. Economic diversification, once capitalized, becomes structural reality. This is why trade economists are sounding alarms. What began as a negotiating tactic triggered investment decisions that will shape North American trade for decades. Canada did not respond emotionally. It responded institutionally. And that response is already visible in export composition, investment inflows, and employment trends. The question is no longer whether Canada can withstand American pressure. The question is whether American policymakers understand that leverage only exists while alternatives do not. What makes this moment historically significant is not just what Canada did, but what others are now learning from it. For decades, American trade leverage rested on a simple assumption. Access to the U.S. market was so essential that no serious economy would ever risk losing it. That assumption shaped negotiations, enforcement strategies, and political rhetoric. It allowed Washington to treat trade relationships as conditional privileges rather than shared systems. Canada just demonstrated the limits of that model. By choosing diversification over concession, Ottawa exposed a structural weakness in pressure-based trade policy. Leverage only works when exit options are limited. Once credible alternatives exist, pressure accelerates independence instead of compliance. This lesson is not being lost on other American allies. In Europe, policymakers are watching closely. The European Union has spent years debating strategic autonomy, particularly in energy, technology, and defense supply chains. Canada's response offers proof that diversification is not just theoretical. It can be executed rapidly when political will aligns with institutional capacity. In Asia, the signal is even clearer. Japan and South Korea already balance deep security ties with the United States against growing economic interdependence with China and ASEAN markets. Canada's experience reinforces the logic of hedging. Not breaking away from the U.S., but ensuring that no single partner can weaponize access without consequence. This is how multipolar economic systems emerge, not through confrontation, but through redundancy. From Washington's perspective, this creates a strategic dilemma. Publicly, the administration cannot acknowledge that its tariff strategy triggered a long-term erosion of influence. That would undermine the broader narrative of strength and control. Privately, policymakers face a more uncomfortable reality. Even after granting USMCA exemptions covering most trade, Canada continued executing its diversification plan. That tells you everything. The goal was never simply tariff relief. It was structural insurance. As the mandatory USMCA review approaches in mid-2026, Canada will enter negotiations with a fundamentally different posture than it held during the NAFTA renegotiation years earlier. Then, Ottawa negotiated to preserve access. Now, it negotiates knowing access is important, but no longer existential. That changes everything. Negotiations shaped by mutual dependence behave differently than negotiations shaped by asymmetric reliance. Pressure loses efficiency. Threats lose credibility. Compromise becomes the only viable path. For American workers, this shift carries real consequences. Agricultural exporters losing Canadian market share may not regain it. Manufacturers integrated into cross-border supply chains face higher long-term costs as redundancy replaces efficiency. Energy markets price in political risk that once seemed unthinkable between allies. None of this produces immediate collapse. That is not how advanced economies fracture. The damage appears slowly, embedded in investment decisions, hiring plans, and infrastructure placement. The greatest irony is that Canada's strategy is not anti-American. It is pro-stability. Carney's government has been explicit. The goal is not severance. It is optionality. Trade with the United States will continue, but it will no longer be the sole pillar supporting Canada's economic future. And once that mindset takes hold, it spreads. This episode should force a deeper reassessment of how economic power functions in a world where capital, technology, and markets are mobile. You cannot compel loyalty indefinitely through pressure alone. Eventually, pressure incentivizes escape. That is the lesson Canada internalized in 2025. The broader question now is whether Washington will internalize it too. Because if the response to this episode is simply more tariffs, more enforcement, and more transactional demands, the outcome is predictable. More allies will quietly follow Canada's example, not loudly, not dramatically, but methodically. Economic influence does not disappear overnight. It erodes when trust is replaced by calculation. What we are witnessing is not the collapse of North American trade. It is its rebalancing. And rebalancing, once underway, is extremely difficult to reverse. That is the true consequence of this moment. Not a trade dispute, a structural shift. And history suggests those shifts tend to last far longer than any administration.